Picture this. You found the deal, the numbers work, the property cash flows. You're finally ready to pull the trigger on your next rental property, and the bank says no. Not because the deal is bad, not because you're irresponsible, but because your tax returns look like you make less than you do. Sound familiar? There's a reason and there's a solution. Stay with me. Most real estate investors hit the same wall. You do what you're supposed to do, write off your expenses, run properties through an LLC, build a real business, and then the very system that's supposed to help you grow disqualifies you for it. Conventional loans were built for W-2 employees with one job, one income, and one property. They were not built for you. And that's not a flaw in you, that's a flaw in the system. Here's what most investors don't know. There are two completely different loan worlds, and you may have only been shown one of them. Conventional loans qualify you. Your income, your tax returns, your debt-to-income ratio, they cap you at 10 financed properties. They demand your financial life look a certain way. DSCR loans qualify the property. One simple formula, does the rent cover the mortgage? If yes, you're in. No W-2s, no tax returns, no income verification whatsoever. That's not a loophole. That's how professional investors finance at scale. Now here's where I'm going to be straight with you, because the people who only tell you the upside aren't your friends. DSCR loans carry a higher interest rate, typically a half point to a full point above conventional. On a $300,000 loan, that's roughly $100 to $150 more per month. That matters. You need to factor that into your cash flow math before you commit. The down payment is also higher, planned for 20 to 25% versus as low as 15% conventional. And there's the prepayment penalty. Most DSCR loans come with a step-down structure. Sell or refi in year one, you could owe 5% of the loan balance as a fee. That's a $15,000 surprise you don't want. Conventional wins on rate and upfront cost, period. If you have clean W-2 income, strong DTI, and you're buying property number 2 or 3, conventional may be your better play. But here's where DSCR changes everything. When you're self-employed, when you've maxed out the 10 property conventional cap, when your income on paper doesn't reflect what you actually earn, when you're buying through an LLC, when you found an Airbnb that cash flows at one point forks, but no conventional lender will touch short-term rental income. That's when DSCR isn't just an option, it's the only path forward. Investors who understand both tools don't pick one and ignore the other, they sequence them. Conventional early, DSCR to scale, cash out refi to fund the next deal, rinse and repeat. So here's your next step. Before you apply for anything, run your numbers on both. What is the property cash flow at a conventional rate? What does it look like at a DSCR rate? Does the deal still work? Because a good deal works with either loan, and a bad deal doesn't work with any. If you want a side-by-side worksheet to do that math yourself, I put one in the description below, completely free. And if this video helped you see something you didn't see before, hit subscribe. Because every week I break down the stuff your banker isn't telling you. I'll see you in the next one.